There was a successful team out of Israel that had about sort of 3 or 4 core guys with about sort of 7 or 8 support guys around them that developed an algorithm that traded interest rate markets, so yield curves across interest rate markets. And in the end, it was doing about 30% of our volume. So, I'd say a team of sort of 6 to 10 people were doing 30% of the volume that we were doing of 700 traders.
Wow.
I witnessed the growth and the success of that. Fast forward some years later, I was in Chicago and hired by a smaller proprietary trading group that was doing some automated trading, some discretionary trading, what I would call sort of black box, grey box, and discretion. And I was brought in to help them develop their automated trading. And I kind of really didn't appreciate, one, how fast the space was moving beneath us, and two, the sort of financial runway we would need in order to compete. And this is sort of around sort of 2016, 2017, moving into 2018, when a lot of the high frequency, low latency strategies were moving into the single digit microseconds for execution.
Wow.
And then, believe it or not, there were, some very well capitalized firms, and these are the ones that survive today, like Jump Trading and DRW and places like that, who were looking to try and shave nanoseconds off order execution.
Oh.
So, I kind of like had a bit of a front row seat to that. We never managed to make a success of that at the smaller firm that I was with. I still believe that the firm out of Israel is still operating today and doing okay. I'm sure they're finding it. I have found it increasingly difficult over the years with the level of competition and things.
So interestingly enough, yesterday I attended an event here in New York, and it was a quants event.
Yeah.
And we're talking the smartest minds in the city, and it's just people that are deep in AI, large language models, quants, physicists, and they're all in the finance sphere, hedge fund managers. It was an insane environment.
Yeah.
And I could see all of them very passionate just about AI and algorithmic trading. And it seems like discretionary trading was not even a thought. It was this was the future. I caught one of them at the end of the event, and I was asking him about what is his views on the future of it. And he said, well, the ability to make profit in the market is because there is an information gap. And you're exploiting that information gap, because I think I'm going to buy today knowing that someone else will buy it at a higher price.
Right.
So algorithmic trading, in the short term, you have an edge. But then as more AI gets involved, this gets squeezed and then it kind of cancels out. So he was theorizing that it's almost like a pendulum, where there might be periods where algorithmics are doing very great because there's a gap there, and then they slowly get squeezed out, and then it's back to just flat markets and kind of cyclical. Is that something you experienced, or any comments on that thought?
Yeah, I think he's wrong. I think there's room for every type of trader in the market, and there always will be. And I'll just explain why I think that based on my experience. So when I started on the floor, we were very much market making, bid and offer, trying to sort of like take a tick out the market and scratch. And that carried on to my off-floor trading on the screens, legging in out of spreads, trying to take, I was manually, basically high frequency trading, but manually with a mouse initially in the early 2000s. And eventually that edge went away. Why? Because algorithmic trading, quantitative algorithmic, high frequency, or let's just bucket it into automated trading, came in and was able to do what I was doing manually faster. The calculations, the execution, and without emotion. And for me, that was like, oh, this is it. This is the end of day trading for discretionary traders. And then, I actually, around that time, I left and joined the exchange. And that role took me into business development around the world, talking to different funds, different trading groups, different banks around the world, trying to drive more interest in the exchange's products. And in that role, I started working with proprietary trading groups out of China, India, Eastern Europe, and Israel, and places. And there were people making money, discretionary trading. And, I just came to realize that my edge had been eroded, but there was still edge in there for discretionary traders, And, today we have someone in our live trading account who's discretionary trading, and, he's up 150,000, and he's been consistent in his approach, and he's grown that account well. And, and he's still managing to do it today. So I feel like there is always opportunity. And what we somebody used this analogy, and I quite liked it. I don't know how good it is, but I quite liked it. And that the market is almost like an ocean. And at different levels of the ocean, on the surface all the way down to the bottom, you have different ecosystems. And within those ecosystems, if we're looking at trading, different types of trading exist. So at the top, you might have long-term asset management or discretionary global hedge fund, global macro hedge fund trading. And at the bottom, you might have low latency, algorithmic, AI-driven quantitative trading that's market making in fractions of a second, trying to take, well, it's not even a tick. Some of these strategies are like quarter or an eighth of a tick out the market because they do multi-leg strategies, scratch, 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 and the cost of that reduces the value of the tick all the way down to a quarter or an eighth.
Wow.
And if you're a discretionary retail trader and you try and swim up and exist in the top part of the ocean, you don't have the deep pockets to run a position offside for 2-3 months like a hedge fund might be able to. If you swim lower, you can't exist in that ecosystem because you don't have the infrastructure, the speed, the strategy maybe, or even the cost of trading. These high frequency firms have memberships at the exchanges that reduce the cost of trading. That high frequency firm might be doing favors to that exchange, making liquidity in illiquid products that they're trying to promote in return for fee credits. So they're trading at very, very low cost, and you can't compete with that. And this is like kind of one of the things that I try and drive home to our traders is that I see a lot of retail traders really trying to scalp, and what they end up doing is, it's a little crude, but they end up like feeding like a chicken but shitting like an elephant, and they'll pick up, or some people used to say picking up nickels in front of a steamroller. So you're scalping, you're taking a tick, 2 ticks, 3 ticks, and then all of a sudden, huge losses. Or that strategy is nowhere near as profitable and can't be run as profitable as somebody in a professional trading group because your round trip fees, your commissions in futures are much higher to the retail trader, and the professional trader's trading at a fraction. So if you can't compete with them. But there is part of that ocean you can compete with other retail traders, swing traders, whatever it might be. So there is room for all types of trading, and I believe it will remain that way.